whereby I introduced to you the definition of GDP and then the two methods to calculate. First, using the expenditure approach, okay, and then the second one is using the value-added approach, which there's nothing much actually to discuss in the value-added approach. Just the main issue that we covered on the value-added approach is the double counting issue. Okay, so but the main method that we will discuss or that we're going to use most of the time will be the expenditure approach. Okay, and whereby the component is based on the C plus I plus G plus net export or X minus M. Okay, so that is the main components under the expenditure approach. Okay, so the main thing that you need to know is the components, okay, which one that you need to plus, which one that you need to minus. So we went through this simple exercise or example, okay, from the slides that gives you, I think, a good idea to calculate GDP and also GNP. Okay, so what is the difference between GDP and GNP? We already discussed last Monday. Okay, so go back to the lecture from last Monday to see the difference between GDP and also GNP. Okay, how do you arrive at GDP and also GNP at market price, and also at factor cost when you take into account depreciation. Okay, so that was the main part that we covered last Monday. Okay, secondly is on the value added approach. Okay, there's not really any formula that we discussed, okay, last on this value added approach. The main thing that because this part actually the calculation is made from the producer side, so that's why there is no like one exact formula to or components that we can see like the expenditure approach or even the income approach. Okay, so the main thing that you need to know is the issue of double counting. So what are the components that need to be that you cannot count twice, okay, especially on this intermediate goods. Okay, I give example as like the tire. Okay, if you manufacture a car, the tire is part of the intermediate goods, meaning it's a component. You cannot calculate, you cannot add the value of tire as a separate item on top of the finished car. Okay, so because then you will increase the value of the car twice. Because you're adding the components on top of the finished value. So that is the issue of double counting. So at the end of this lecture, so we will discuss some questions on past years, and one of them will be on this issue of double counting. So the last method, the third method that we're going to discuss today is the income approach. So the word income, okay, is money received, okay, from salary, from wages, okay, from profits. So that is the basic idea of income approach. So basically is the by taking or summing, okay, adding all the income earned by different resources. So it can be from wages, salary, rents, rental, okay, net interest, undistributed profit, okay, sold. So this is income from owners of buildings, okay. So so you have first GDP as well and also GNP using income approach. So to arrive from GDP to GNP, you need to add net factor earning from abroad, meaning money received by Malaysians from overseas. Okay, so GDP and GNP. So this component here will differentiate or will convert GDP into GNP. And finally, from gross to net, okay, so this is similar what we covered last Monday. To arrive from gross to net, you need to minus depreciation. Okay, so there's no different in terms of the general idea from gross to net. Expenditure approach also you need to deduct by depreciation. Okay, so again, the rest of the slides is basically just going through in detail. Okay, from GDP you plus income, depreciation, tax minus subsidies. Okay, so and net factor in payments to the rest of the world. For this kind of for this topic, actually, the thing that I don't I don't really like so much to go too much into detail, is because many of the students cannot really actually see the connection between so this is between the two methods, okay, income approach versus expenditure approach, especially the component inside. Okay, so the other slide that you can find also in your OL, okay, which is similar to the one from the from the main book slide, okay, GDP National Income. Okay, so using the income approach, okay, is the same thing. So basically, when if you, I mean, of course, at this stage you cannot really appreciate or visualize what are business transfer payment, what is net factor payment to the rest of the world, because one of the limitation of learning principle of economics, because you only learn this just on the surface. Okay, we don't really go into detail. So the main goal is, as long as you know the difference between components that should belong in the GDP under expenditure approach versus the income approach. Okay, so these two, because the value added approach, there's not much to discuss. Okay, so the thing that will, I think, confuse the student is between income versus expenditure approach. Okay, because some of the components may appear in the, I mean, that if you look at past year's questions, okay, some of the components, they, I mean, the question is designed to see whether you can differentiate which component belong to the income, which component belong to the expenditure approach. So if you are required to calculate GDP using expenditure approach, so you only use the component that should belong in the expenditure approach. Okay, so I mean, you can always refer to the slide or to the notes, okay, to the book, or you can find additional materials online on this. Okay, so let's see this. Okay, so the income approach. Okay, basically the thing that you need to add are all based on income. Okay, profit, salary, wages. Okay, and then you add depreciation. Okay, tax minus subsidies. Okay, because tax is money to the government. Okay, subsidy is the government gives money to the people. So that's why you need to minus subsidy and you need to add tax, because this basically income to the economy, to the government. Okay, and then factor to the rest of the world. If this is positive, then you need to add. Net means what we give and what we get. So if the net value is positive, then you add that. Okay, others depending whether if the sign is positive or negative. Okay, so that is basically the main component of GDP using income approach. Okay, if you look at this, personally, I don't really like this topic so much, because there's a lot to cover, but we only cover on the surface. Okay, so when it comes to testing the student knowledge on this, okay, that's why I think I would prefer the expenditure approach topic rather than, because that will be more relevant. We can see the components and the application, the investment, consumption. Okay, but since this is part of your syllabus, the main thing is just, okay, just focus on the components inside the expenditure, inside the income approach, as what you see here. Okay, so what you need to add, okay, as long as you can differentiate, so these are the common components under income approach. And compared to last Monday lecture on the expenditure approach, what are the common components under the expenditure approach? As long as you can differentiate between the two, that should be fine. Okay, so that is, I think, that the main goal of this chapter. Okay, so that you know, we don't need to cover too much into detail what is net interest. Okay, because at the end of the day, you are not going to require to explain each of these component. Okay, as long as you know that this component belongs to the income approach, which one that you need to add, which one that you need to minus. So this is basically the main thing. Okay, on this slide number 63 in your OL. Okay, so yeah, and then this is just the summary that you can see here, which sum up the whole components that usually belong to the income approach. Okay, So as long as you can figure out and differentiate between this and expenditure approach, okay, we already discussed that one last Monday. Okay, I showed you that summary slide, this one. Okay, so you can see the difference between expenditure approach, okay, consumption C plus I plus G plus export, okay, net export, okay, versus the one that you see under income approach. So they are completely different components. Okay, so yeah, so that is what I want to highlight for this chapter. So no need to go, no need to read too much into detail what is capital assumption allowance. Okay, as long as you know the heading. Okay, so this actually belongs to the, if you want to calculate GDP, so these are under income approach. These are the components that you need to use. Okay. Yeah, so this is the same slide as what I showed just now. Okay, so no need to worry about this detailed accounting. Okay, if you look at some of the past year's question, it's quite straightforward. Okay, I will show you one question at the end of before we end our lecture today. Okay, just a revision on the past year question, so that you can get some idea how the questions on each of these method, okay, will be asked. Okay, so you can go through some of this exercise, but I'm not really keen to discuss this in detail, okay, because we don't really actually test the student on this. Okay, one thing that before we end our, before we finish chapter number 9, one thing that you need to also pay attention is the difference between nominal GDP and also real GDP and also GDP growth. Okay, kadar pertumbuhan ekonomi or GDP or economic growth. So this is the last part of chapter number 9 that you need to uh, really understand, because especially on the GDP, the real GDP, the economic growth formula. Okay, how do you calculate GDP growth? Okay, so first, what is nominal GDP? So I think by now, when you learn chapter number 8 about inflation and also unemployment, okay, especially on inflation, okay, we discussed that. I think I used the online video, the recorded video for you to learn that, okay, especially on the inflation. So inflation is, if you want to convert from nominal into real, you need to take into account the inflation value. Okay, so what is the value of inflation index? Okay, so nominal, so the difference between real and nominal is real after you take into account adjusted for inflation, okay, or GDP corrected for inflation. So that is, for example, here you have the nominal GDP, okay, versus the real GDP. Okay, you can see here, real GDP usually will be lower than the nominal GDP, because usually when it comes to inflation, when it comes to price index, okay, the price keeps on going up. So the value of real GDP usually will be lower than nominal GDP. Okay, so you can see many examples, okay, whether online or in YouTube videos. Okay, how to calculate real GDP. So this is just one example that you can find. Nominal GDP, okay, GDP 1,130, GDP 2,292. Okay, so the difference between GDP 1 to GDP, between GDP, let's say 1 is GDP year 1, GDP 2, GDP year number 2. Okay, so between year 2 and year 1, so to find the changes will be around 225%, meaning 2 minus 1 divided by 1 lah. So this is just formula to calculate growth. Okay, so you get 2 to 5. But if you convert from, if you calculate in terms of real GDP growth, okay, so you can see that real GDP year 1, 130, real GDP 2 is 176. So the changes will be only 35%. Okay, so this is, but if the base year is year 2, then you get the changes will be 31.2%. Okay, but the main thing that I want to highlight is this one. Economic growth is calculated based on real GDP. Okay, so whenever you see a report from Central Bank or Department of Statistics, okay, from Malaysia or any other countries, okay, whenever they talk about economic growth, okay, so how do you calculate economic growth? Is based on GDP, okay, but not nominal GDP, but real GDP. So how to calculate real GDP is you need to adjust for inflation. Okay, so you can find this out, okay, because maybe the one in the slide is not really that clear. Okay, but you can go to YouTube, you can go to online, just type how to calculate real GDP. Okay, you will find, you know, a lot of simple example for you to refer to. But at the end of the day, what is needed for you to know is the calculation of economic growth, okay, from last year to, for example, this year is 2021. Okay, so at the end of 2021 in December, okay, we want to know how much does our economy grow, or even not grow, maybe decline, okay, compared to last year, because COVID-19 caused many economy to actually the economic growth to become smaller, okay, not growing but decreasing. Okay, so the formula, you must use real GDP instead of nominal GDP. So the growth formula is the same of any other formula. Okay, current value minus previous value divided by previous value multiply by 100. Okay, so the main thing is to calculate economic growth, we need to use real GDP, okay, not nominal GDP. Okay, and one of the last few parts of the topic is on business cycle. I think I covered this part in the chapter number 8, okay, when we cover on the introduction to macroeconomy. So I don't think that I need to repeat this part again. So the peak, contraction, through, and a recovery, expansion. Okay, because I think you can see some past year question on this, okay, on the phases pasar of the business cycle. Okay, so which one is the peak? Okay, which part that refers to the peak point? Peak is meaning when the economy is at its highest point, and then now is contraction. So maybe we can see our economy now is during contraction period because of COVID-19. Hopefully, when you know the COVID-19 cases has gone low, okay, and the economy starts to, so through is basically the bottom point of the economy, okay, and then once you finish through, we are starting on the recovery phase. Hopefully we can recover from COVID-19 pandemic, okay, by end of this year, or hopefully by earlier than next year, and then expansion. So from peak, contraction, through, recovery, expansion, and then peak. So this is the cycle of any country in the world. So it's the difference is how long you are going to be in the through, in the recovery. Some are very slow here, some are very fast. Some they reach the peak very fast, some they reach the peak very slow. Okay, so that is on this business cycle, which I think we look at this similar graph in chapter 8 before. So there's nothing new that we are discussing in this slide here. Okay, so other than that, I think that is the main part. Okay, GDP per capita, I think I already discussed this. Okay, so you can use both slides. Okay, because some of the slides there might be some changes or difference in the way the points are being discussed. Okay, so per capita means GDP divided by the number of population. Okay, so I think we discussed this part also last Monday. Okay, real versus nominal. Okay, so real value after taking into account inflation. Okay, the word constant price means adjusted for inflation. Okay, so nominal GDP is based on the current price of the economy, meaning we do not take into account inflation yet. So that is the same thing that we discussed just now. Okay, so this is just another example from the other slide, real versus nominal GDP. Okay, price multiplied by quantity, you get the total of the money spent, okay, at nominal value. Okay, and then to convert into real GDP, so you can see this simple example here. Okay, I do not want to teach you how to calculate, because these are just simple calculation. Okay, between so the value of 2013 at 2012 price. So because real GDP, you need to have a base value or base price. So usually if you want to look at 2013 real price, you need to compare against the price of the previous year or the base price. So 2012 is considered as the base price. So what we do here is basically converting to a 2013 price in terms of 2012 price. Okay, and you can get the price of 2013 in real value, meaning adjusted for inflation. Okay, so this is basically this is similar to what we covered in chapter 8. Okay, converting from nominal into real values adjusted for inflation. It's just that this time around we use the word GDP. Okay, but converting from nominal into real values, in chapter 8, we already covered that. Okay, so there's no difference between what you see in the real value, real versus nominal GDP, because both are still using inflation concept. Okay, so please go back and watch the video which I gave you the link in your OL for chapter number 8, okay, when we discuss about unemployment and inflation. Okay, and also some of the exercises that I discussed, okay, in that video, okay, from last year or from last semester video. Okay, so yeah, and then if you plot the real versus nominal, usually real GDP will be lower than nominal GDP, but not all the time, depending on the price level. Okay, so that is just some idea of between real versus nominal. Okay, so I think towards so the rest of the time, I mean another maybe the next 20 minutes or 30 minutes or so. Okay, so what we need to discuss is the on this national, I mean chapter number 9, some of the past questions that we can look at. Okay, so first, what is national income accounting? Okay, which is the definition of the beginning part of chapter number uh, 9 that we covered, okay, this week. Okay, what is national income accounting? Okay, national income account. So that is what is being asked here. So what should be the correct answer? So what should be the solution? Number 9. Okay, national income accounting provide a set of rules and definition for measuring economic activity. Okay, so it should be clear. Okay, so double counting in national income accounts will not occur if gross domestic product is computed by summing all. So this is related to the double counting, which is what I highlighted before on the product, this value added approach. Okay, so it will not occur if you only take into account what? Okay, so when can you avoid double counting problem? Okay, so the correct answer should be what? A, B, C, or D? Okay, you choose D, production cost. Okay, it will not occur if you only sum A actually. Okay, which is the sales of final output. Okay, if you recall from the slide, the issue of double counting. Okay, in the production in the value added approach is because the is when you add intermediate goods. Okay, value added production less intermediate goods, meaning we are only interested in the sales, in the value, in the final sales value. Okay, not in the value of production sales less value of intermediate goods. Okay, so it should be A, sales of final output. Okay, 11. Okay, what does annual economic growth refer to? Okay, increase in nominal consumption, investment, or real GDP. So I just mentioned just now, economic growth, okay, refers to an increase in, we are using real. It was, I mean, okay, so it refers to real GDP calculation, okay? Okay, number 12, which of the following will not be counted as final inclusion of GDP? Okay, so again, this is on the, of course it's not mentioned here, but this is actually about value added approach. Okay, A, B, C, or D. Okay, will not be counted. So I mentioned before, you want to avoid including intermediate goods, okay, as part of the calculation from Okay, so the correct answer actually should be B. Okay, a sheet of glass purchased by commercial, yeah, will not be counted because glass purchased by commercial bidder of a new home. Okay, the glass is part of the input or the intermediate. Okay, you put glass, for window. Okay, just like a rubber or tire. You use the tire to make up the car. Okay, so a glass purchased by commercial builder of a new home, this is not final good. This is intermediate good. So you cannot include this as part of GDP calculation. But if you look at A, what is A versus B? A piece of glass bought by consumer to fix a broken window. So this is actually not, so this is basically like you go to the shop like Mr. DIY or test or any hardware store to repair your own house. So this is considered as final good. Okay, C, okay, if you look at the notes in the slide, okay, what are the, I mean, what are the components that can be included as part of this value added? Okay, it's also including which one just now? Um, okay, so never mind. So C actually a sheet of glass produced this year and ending up in inventory of retail store. So the word retail store means, so it's already finished, meaning it is no longer the input. So it becomes like final good already because now it's being put in the retail store. A home that built this year but not sold. Okay, so even though this is not sold, but it's already been completed. So it's already a final good or finished good. Okay, so only B that refers to intermediate good because glass used by commercial builder, by contractor to build a new home. So B actually is part of the problem of double counting. So as long as that input is still not is used as part of the production process, you cannot include that in the GDP calculation. Okay, so question 13. Okay, so the word net from GDP, okay, we need to deduct with depreciation. So I mentioned this again earlier. Okay, so is A correct? Okay, spending on capital equipment, inventories, and structures is referred to as what? CIG or X minus M. So I think this is very straightforward. Okay, so definitely it should be under investment because capital equipment, okay, the word capital, okay, refers to investment. Okay, consumption is on, okay, goods and services on the consumer side. Okay, government expenditure. So if you're not sure, go back to the slides and see what are the detailed breakdown of this each of the component here. Okay, 15. Okay, question 15. Personal income is what? So again, this is already covered in the slide. Okay, go back to the slide, see what is personal income. Okay, so it should be D, the amount of income individual actually receive. So this is personal income. Okay, disposable income is different. The one is after you pay tax. So again, okay, I think this is a very simple, straightforward question on the definition. Okay, that you can get directly from the notes. Okay, last question of today. So you are given this information, this one simple table. Okay, calculate GDP using the above table. So this is where I mentioned just now, you need to know what are the components of the expenditure approach and what are the components of the income approach. So this question, you need to use either one. You cannot use both. Of course, there is no mention about use expenditure approach or use income approach. Okay, value added approach, I think I mean, there is no question on using value added approach method. Okay, except question on the double counting problem. Okay, and then okay, so here what you have consumption, you have investment, you have transfer payment, government expenditure, export, import. So if you look at, so I think there are two components here. One is the one that should belong to the expenditure approach. For example, C. So this is I. Okay, so this is G. This is X. This is import. Okay, so then you have another two component which is outside transfer payment and net foreign factor income. Okay, so transfer payment, you can check, please go and check your notes. Where does transfer payment appears? Does it appear on the calculation of GDP, or does it appear on the calculation of NDP? Okay, or does it appear on the calculation of GNP? Okay, the same thing as net foreign factor income. So because you are talking about GDP, okay, so we do not want any components that is not used to calculate GDP. That this component may belong to the expenditure approach or income approach, but it is not used for to calculate GDP. So so I think this is the kind of question that you can expect to get. Okay, so be careful of, be alert on what are the components that belong to GDP, to GNP, to NDP. Okay, so I think in the slides, I think it's quite clear. Okay, which one, how do you arrive from GDP and converting from GDP to GNP, and from GNP to let's say NDP and also NNP, net domestic product, net national product, okay, gross national product, gross domestic product. So we already discussed that last Monday. Okay, so since these two items should be excluded, so what should be the answer for number 16? Okay, so C plus I plus G plus X minus M. So the answer should be B lah. Okay, so transfer payment, check your notes where this belong to. Okay, net foreign factor income, also check your notes or slides or books. Okay, where should this belong to? Okay, so this is one of many questions that you can find, that you can see how questions on chapter 9 can be formulated. Okay, so again, there are many past questions on the web that you can look at and discuss among your friends. Okay, we don't have time to discuss every single question from the test bank. So yeah, so this topic will be covered as part of your test number 3. Okay, which I think if you check your group WhatsApp, I think we already discussed that. I already mentioned some of the proposed date. I think it should be somewhere on the first week of June. I think on the 10th of June. Okay, should be the deadline or the proposed date for test number 3. That I think will cover chapter 8, 9, and 10. Okay, the first 3 chapters for macroeconomics. So this is chapter number 9. So by next week, we're going to start on chapter number 10, okay, for another week. And then a week after that, you're going to have your test number 3, okay, the first 3 chapters for macroeconomic syllabus. So check back, I think your group WhatsApp, okay, sometime like 2 or 3 weeks ago, okay, I put up, I send you the schedule for your test 1, test 2, test 3, and test 4. Okay, so the remaining question will be on chapter, so this will be on chapter number 10. Okay, so again, go back to the video, okay, this week, and also the one that I only refer to the last semester video on inflation and also unemployment. Okay, there are some questions that were discussed on that. Okay, you can refer to your OL, okay, refer to the link that is provided in your OL, okay, for the links of the video, okay. So again, so that if there is no other questions, so inshallah I'll see you next Monday, okay, for further discussion.